we're talking about investment, I suppose knowledge of the business financially gives you confidence then to be able to invest on the back of knowing, how that investment is likely to perform and whether it's going to work for you and add to the business itself. So good business management is critical when we're talking about the whole area of investment.
Costs over the last number of years in running a commercial dairy farm have increased significantly. Albeit farm gate milk prices are higher than the long-term average, it's still important investment decisions are made that benefit the business in the long term. I'm delighted to be joined this week by Teagasc farm management specialist Kevin Connolly, who outlines why farmers should make informed decisions when it comes to managing their farm and business, and how to best complete an investment appraisal. I started by asking Kevin to give us an insight into the outlook for dairy farm margins for 2025.
Looks fairly positive, James. I mean, obviously we've had a bit of volatility over the last, if you look back over the last number of years, good years and bad years and difficult trading conditions and difficult weather conditions. If we take the 2024 year, we had a difficult enough spring, but it finished out strong enough. I suppose dairy farmers are coming in, fairly positive, or we're coming in fairly positive to 2025. And I suppose that the spring and early summer of 2025, as we know, has put everybody in reasonably good form. So I'd think it'd be fair to say from a financial perspective, dairy farming is in a pretty strong position in 2025, and it's looking reasonably positive. And from a cash flow perspective, there should be reasonable strength there and scope there for farmers to look at investments for this year coming.
Yeah, we spoke about we'll say the business management side of things. When we talk about business management, what do we actually mean?
Yeah, look, at good business management, I suppose, applies no matter what business you're in. It's critical to have a kind of certain foundation in place. If you want to manage the business well, and key to that really, I suppose, is a good sound knowledge of how the business works from a financial perspective, how money flows through the business, what impacts kind of some of the events that have happened, say, in previous years have impacted on that financial perspective of the business, and I suppose an understanding of those risks and whether there's scope there within the business and the management of the business to be able to deal with those as they happen, or whether you need to plan for them in advance and have something there to allow you to manage those risks. And when we're talking about investment, I suppose knowledge of the business financially gives you confidence then to be able to invest on the back of knowing, how that investment is likely to perform and whether it's going to work for you and add to the business itself. So, good business management is critical when we're talking about the whole area of investment.
You mentioned that earlier. I suppose we were in a time of, volatility and increased production costs, and albeit, as we said, farm gate milk prices are higher than the average. It has left, I suppose, a higher level of exposure there. So managing cash is often spoke about, Kevin, in tough years. You've outlined that there will be surpluses of cash on a lot of farms this year, obviously. Does that mean that we don't manage cash flow throughout the year?
No, I mean, I suppose cash flow management, as you say, James, sometimes has this kind of negative connotation around it, like where it's very much dealing with cash deficits and there's no cash about. How do we manage that? But equally, I suppose, in a good year where there's cash surpluses there, being, I suppose, strategic and clear thinking around how you're going to use that cash to the best benefit of the business can take a bit of effort as well, and a bit of thinking, and maybe a little bit of standing back and not rushing in to where the bank account is looking fairly healthy and spending in the wrong areas. Making sure that surplus cash, if you have it, is invested correctly, can be critical in setting the business up for a better future. And equally, if it's spent in the wrong place, well, it's very hard to take it back. You can't spend it twice. So, it's critical that you manage those surpluses properly and get the best out of those. Because as we know, we will have good years. We're likely to looking at a good year this year. It could be the case there'll be bad years to come, or difficult years to come, and those cash surpluses would be most welcome in those years if you're able to utilize them.
And that's really the idea, I suppose, of, for want of a better term, a rainy day fund, Kevin.
It is, James. Yeah, I mean, this rainy day fund. I suppose when you're looking at the kind of weather we're having at the minute here in May in 2025, it's difficult to be even thinking about rain. But although some farmers might be looking for rain, but it's I suppose having that buffer there of a fund that you can call on is a useful thing to have. And in the years that you have a cash surplus, if your rainy day fund or your cash reserve fund, if you like, is looking fairly low, it's a good idea to kind of recharge that, put some money aside before you even consider spending any surpluses after that.
Yeah, yeah, yeah. And managing cash flow, and for farmers that aren't, Kevin, how easy or difficult does the process need to be? How complicated does it need to be? Where would people maybe actually start with managing cash flow?
Look, it can be as simple or as difficult as you want to make it, James. I suppose. I think it'd be fair to say that with a lot of the systems that are available now, there's an awful lot of more information available to farmers to be able to manage the financial aspects of their farm. Whether it be just as simple as accessing online banking and having that information available at your fingertips, and making use of some of the accountancy reports that are available there through your accountant, and some of them provide more regular kind of feedback or accounts information, provided I suppose that you're providing them the information to do it for you. We have the likes, obviously, the profit monitor in Teagasc that allows you to look at your financial situation on a yearly basis and benchmark it, and work out your profitability and your costs of production. But then on an ongoing basis, something monitoring cash flow or putting a system in place to be able to track your cash flow during the year is a great thing to be able to do. And quite a few farmers are at that now. I mean, we have our own system for that, the cost control planner, which allows you to monitor cash in and cash out on a regular basis during the year, and it really gives you a handle on how the business is operating financially, and it allows you to budget as well, which gives you a fair bit of confidence then if you are going to do a bit of spending or making any change in the farm business as to how the farm is going to react as a result.
So really, what I'm hearing there, Kevin, is it's get something maybe that works, and it's going to be different for individual farmers. But does it come down to maybe just having the discipline to, whatever, once a month sit down and to look at the budget and maybe budget forward in terms of how are we looking? Are we building surplus, maybe quick cash quicker than we thought, and how that might impact our decisions later in the year?
Yeah, it is. It's. I suppose some farmers would say you're asking me to do another job on top of all the other jobs I have to do. But it is a fairly important part of managing any business to be able to understand how cash moves through it, where are the areas that are the times of the year when cash is building, and where are the times of the year where there are deficits. And if you can see that, there's significant kind of surpluses or deficits building, then you're able to react to that if you have knowledge to it. And I suppose something like a system like the cost control planner or something like it gives you that bit more information than just looking at your bank account balance. It tells you where the money is coming from and where the money is being spent. And then building a budget alongside that, James, just allows you then to kind of look at where you are currently, and then look forward for a period to see, well, what's likely to change in the next number of months. And that gives you great information then to be able to react in time and put the plans in place. Some of these investment decisions that that people might be planning, it's something that takes a bit of time. It takes a bit of planning to put in place. It's not something you really want to be doing on the spur of the moment, and you really need to be using good information to back that up. And that's where something like a cash flow plan is very useful.
One area maybe which I want to touch on before we go on to maybe the investment appraisal piece is, And it often comes up in good years, or subsequent to pretty good years, is that whole area of taxation, and maybe often poor decisions are made, Kevin, to try and avoid paying tax. How can farmers maybe plan around this?
Yeah, James, I think it's fair to say, tax and even the likes of availability of grants sometimes drives a lot of investment decisions. And there's no doubt about it, the likes of a healthy grant there or the ability to kind of offset a tax liability, it can be a significant sweetener in helping farmers make an investment decision. But I suppose you still need to look critically at the money you're spending on that investment. It may be allowing you to access a grant to offset some of the cost. It may be kind of reducing your tax liability in other areas. But you need to kind of look at the investment on its own and see critically, is that going to contribute to the business? Or what is it going to contribute to the business? Is it a sound investment, ignoring all these other things? Is it the right thing for me to spend money on at this time? A lot of these investments that do generate that kind of additional kind of tax uh, write-off or the access a grant, you're still going to be paying for those investments over a significant period of time. When the tax is long forgot about and the grant is long forgot about. So you need to think about how that repayment, say on the balance of that investment, is going to look like in a number of years' time, and is that investment still going to be contributing to the business? Any investment that's made, it really needs to fit into a long-term plan for the farm. It needs to fit into something that's going to contribute to the business now and hopefully in the future, and is going to maybe be part of that jigsaw of building further investments on top of that, that's going to build the business into a more viable unit.
Is it maybe more important then to the farmers that do find themselves maybe in that situation, where their tax bill has crept up? Is there opportunities around business structure and that space maybe, rather than spur of the moment investments as such?
Yes, yes, definitely. And some farms have made the decision to change their business structure for that very reason. And I suppose there's no one size fits all when it comes to that. Some farms are quite happy to stay as the traditional sole trader. They like the simplicity of that. And they're willing maybe to pay a little bit of extra tax for to just but stay as a sole trader. Some have gone down the partnership route for various reasons, whether it be taking in maybe the next generation into the business, or accessing the incentives there around partnership, which include stock relief and higher TAMS limits and so on. Um, and then there's the company route, incorporating the business. Obviously, the big attraction there is the lower tax rate. But it's a bit like, as we said earlier, James, it's not something you jump into without good planning and a long lead-in time to do it properly. Any rush decision as regards investment, or rush decision as regards change in structure, can sometimes, be the wrong thing to do if you don't have the good information and take the time to plan it properly. But there's no doubt about it. For some farms who were, say, contemplating a major investment on the farm, going down the company route was a definitely a factor that helped make that investment work for them, because they ended up with more after tax income through the company to be able to make repayments on the investment. And that's particularly critical where you're talking about very large investments, the likes of land purchases and so on, and particularly in land purchase where there's no capital allowances there to give you a dig out with making repayments on the loan to finance that investment. Then sometimes going the company route is a good option there in that case.
That's an important point. I think that people need to be aware of, Kevin, around that whole repayment capacity and freeing up cash as such, in terms of for paying down capital. I suppose the important point in that, if we have listeners that's thinking, I suppose that some of that might be applicable to themselves, is, and as you said it, seek out professional advice and make that decision. based on the long term, I suppose, aspirations for the farm and business. From an investment point of view, and you mentioned it in terms of making the correct investments and making them maybe with a view in the longer term and the impact on the business. How would a farmer maybe go about assessing? We've outlined there is going to be surplus cash on farms this year. There is a requirement on farms, I suppose, for continuous investment and updating. So how would a farmer maybe go about making that decision, and what tools are available, I suppose, to farmers?
Look at I suppose the decision process around assessing an investment. It's important because most farms, if you talk to any farmer, they probably have a list of 4 or 5 things that they think, yeah, I'm going to try and invest in that over the next period. But it's a matter of trying to pick the right one at the right time and being able to match that into, as I said earlier, some kind of long-term plan that one builds on the other, that you're building on what you did in the past, and that the investment you make now, whatever you're going to do in the future builds on that. So it's a matter of trying to structure that properly. But the starting point, getting back to what I said at the very first part of this piece, is really understanding how the farm is operating financially. As I said, we're talking about cash surpluses this year, but is that going to be something that's going to continue for the next number of years? Look, obviously we can't use crystal balls to give us accurate figures on what price of what milk price or production costs are going to be, but it's being able to get a handle on what your kind of current cost of production was or is today and what it has been in the past will give you a decent indication what your margin per hectare is. And then on the back of that, then starting to look at your 4 or 5 investments, as I said, that are areas that a farmer might want to invest in, and prioritizing them. Which one do we need to target first? Which is the most critical investment at this point in time for me to make sense that I can build on it? And that might be driven, James, by, it could be something in the policy environment that could be driving that. It could be, trying to make sure that you're compliant from an environmental point of view. It could be an animal welfare issue. It could be someone that needs to invest in additional, calf rearing capacity from that perspective. It could be labor, could be the pinch point on the farm, and that could be something maybe that needs to be targeted to make the farm a better, easier place to manage from a labor perspective. So every individual farm is different, and I suppose getting access or making use of some kind of professional guidance on that can sometimes be useful. That second pair of eyes coming in to be able to work with you as a farmer and assess all these investments and where they fit in, and which is the right one to pick, and which is the best one to give you a bang for buck at this particular period of time can be useful. And the fact that some of those or that professional help can then help you build the likes of a business plan and do your financial projections, it can be also useful to be able to tap into that.
I think I heard one farmer mention before. It's and if you've outlined it there, it's identifying, I suppose, the needs from the wants as such. And we all want certain things, but sometimes we have to identify what's needed, and as you say, what's going to actually deliver for the farm and give the best return on that. The tools, and I suppose the one maybe I'm thinking on, and which is often used for assessing investments is the business planner. And can you maybe just outline to our listeners how that can, I suppose, give a clear vision over a period of time, Kevin, with regards investing in the farm?
Yeah, look, at the business planning tool that we use, I suppose, starts from the point of view of taking a base year, your current year, usually using figures from the profit monitor, and starting off with kind of the existing assets that you have on the farm, the stock you have on the farm, the facilities you have on the farm, the land, obviously, that you have available, and using that as your base year. And then based on the farmer's plans, whether it be an investment in additional assets, land, machinery, buildings, stock, building that in, putting a cost on it, a clear cost on it, and then factoring in the additional costs of running the farm for the year. And if it's additional stock, then also looking at, well, what's the going to be the feed requirements for those stock for the farm, that we're not kind of trying to expand or put stock in place without proper provision for actually making sure that we can feed those stock properly and run the system efficiently, and try and project forward for that over a period of time. And if there's usually a lot of these investments, James, involve a bit of debt, finance as well, and that obviously is a critical component to drop in there to the plan and see what the impact of the repayments on that debt are going to be, and whether the cash flow is going to be able to support that over the period. So the likes of that business plan, and look, it is a projection. It's not going to be accurate to three decimal places in any by any stretch of the imagination. You're making assumptions on costs of the output of that you're putting out the gate in terms of milk and stock and so on, and the cost of the inputs that you're bringing in to keep the farm going. So there's a certain amount of assumptions made there, but it's just to put that down and work it through to see, based on those assumptions, is how is it going to work, and then stress testing it as well based on costs increasing or decreasing, or the likes of interest rates maybe increasing, and see the impact of what that's going to have on the plan. And it just gives that bit of confidence. Yeah, we know that's going to work, or no, that's definitely not going to work, so we're going to have to scale back our plans or finance this slightly differently. So that's really where the business plan comes into its own there, is doing that type of projection.
That's really protecting the fundamentals, Kevin, really, which I suppose is maybe existing capital loan expenditure or drawings, or as the taxation that we mentioned. It allows you that viewpoint to see, right, well, if I do this, can I still meet all the requirements? And often, that drawn ones where it's maybe got wrong, that's the piece that's often maybe pinched, Kevin.
Yeah, it is. It's an area definitely, James, that sometimes gets overlooked. I mean, ultimately, why is any farmer in business? They want to be able to generate income to support themselves and their family, and they need a certain amount of cash there to be able to draw on to live. And over a 5 year period, or a period of an investment, the actual cash needs of a household can change as well, and it's important to factor that in. You could have kids going to college, or additional expense coming through, and you need to try and think of that and build it in. If you go to a financial institution for a loan, you can bet your bottom dollar that they're going to look for that type of information, and they're going to be aware that the farmer's going to have to pay himself as well as make repayments on the loan. So they want to see that built into the plan as well. So it's important to take note of that and to build that into any future projection.
You mentioned there, I suppose, it's really about managing risk. And I suppose one question I have for you here, what are the most common issues you come across, I suppose, where maybe investments haven't went as planned or have put the business under pressure?
Look, I suppose a lot of it is maybe done, if you want to call them poorly thought through investments, is that there's not proper homework done in advance. There was no standing back process. A lot of it was jump in, feet first into it, and hope that it all worked out in the end. And some cases it might, but if there does come a pinch point, then that's going to catch you out. Having a well costed investment, clearly setting out what this investment is going to cost, both to put in place day one, whether it be a capital cost and net of grant and VAT or whatever, but making sure that you have it fully costed to actually that down to the last cent exactly what it's going to cost for you to get it up and running, and then the running costs associated with it, that there's a clear handle on that. And some of the investments maybe that are made don't fit an overall plan. They can seem very haphazard. You're investing in this year, and then any investment that's made will involve either using up cash or a certain percentage of the cash you have, and maybe taking on debt. And that limits then any investment decision that you can make over the next period of time, usually, until the debt is repaid. So you need to think critically, is this the right one? As I said earlier, is this the right one at this time? And it's going to build for the future. And because the investment that you make at this point is definitely going to limit the other investments that you can make in the short term. Um, Structuring debt and so on, finance for investment is critical as well. Not trying to be too ambitious and making repayments on loans over short periods of time that's going to put the business under pressure. Might be fine in a year, maybe like this year, where there's surplus cash about, but where cash flow comes under a little bit of pressure, and you have very high repayments, then it can become tricky, and then making sure, as we said earlier, James, that you have some kind of a buffer or reserve there to call on, when things do start to get tight. And that could be your rainy day fund, as you christened it earlier. Your pot of cash that you can pull out of, usually to make to meet short term commitments as regards production costs, or even repayments in the short term, but also having a credit kind of reserve or credit buffer there. If it's a situation where you're going out to fund an investment with debt, don't maximize your credit capacity, if you like, and plow all your full kind of loan capability into one investment, leaving you with no scope for even a small amount of additional debt to fund even short-term spending or whatever. Or if something some emergency comes up on the farm, some machine tractor lets you down, or something that you don't, you need to have access to short-term debt to finance, and you have no capacity there. Make sure that you have a little bit of a credit reserve there, a bit of unused borrowing capacity, if you like, to be able to call on, and that's critical to be able to offset some of that risk. Because look, we're on the crest of a wave potentially at the moment. Everything looks reasonably good, but as we said, markets are volatile, prices are volatile, the world economy can be volatile, and that all can impact, what happens at farm level. So we need to have an eye on that when we're making these decisions as well.
Maybe one last question to finish it off. And you mentioned there, we're guilty probably, and it's in our psyche, Kevin, to, first of all, a lot of farmers will try to do maybe more than they should out of cash flow. You mentioned it there, if they don't and they do finance it, it's maybe over the incorrect term and puts the business under pressure. With surplus cash available on farms as we move through the year, making that decision on, do we do it out of cash flow or do we finance it?
Yeah, well, look at high cost capital investment, James. Definitely, it should be borrowed for. That's my opinion all the time. Obviously at the right rates and over the right term, where an investment is going to be in a component part of the business for a long period of time. Definitely plowing too much cash at that, to invest too much of your surplus cash into that day one. I don't think is a good use of cash. But it's, in a lot of cases, James, you are still going to be involved. You're still going to have to put up a percentage of the cost of any investment in cash. No lender is now going to do you 100% finance on any investment, and they do look for the farmer to meet them some bit of the way in financing it. So you're talking 20-30% possibly of equity or own investment going into most, or own cash going into most investments. There's nothing wrong, I suppose, with kind of short term or small capital investment being financed out of cash flow. Again, with the health warning around that you have your cash flow reserve, your rainy day fund in place, and it's kept as such and not dipped into for that type of stuff. Once you have that in place, and if there's still surplus cash, then you can look at using that cash to do small capital investment type spending. And even look at I would be encouraging people that have maybe significant debt already on the farm, if there is surplus cash there, maybe a better use of that cash is paying down some of that debt, and particularly if it's at high interest rates, and paying down some of that to give yourself some of that borrowing capacity for future investment further down the line. So having a cash surplus is it's a good problem in a way. Well, it's a good problem in every way, but it can be, I suppose, an area that farmers need to think critically about before they make any rash decisions as to how to use that cash.
Very good. And finally, term, we'll say, for those significant investments, what sort of term are you talking? There's obviously going to be a lot of work done on farms. I would think, Kevin, from a nutrient storage point of view, and as you say, in terms of facilities and stuff, and some of those larger scale investments, what sort of term are we talking?
For the likes of land investment and so on, as long a term as you can get, James, in a lot of cases, and if you can stretch it out as long as possible, particularly high or very high cost expenditure on land, but with flexibility to make maybe additional down payments against the loan, if possible. For the likes of building investment and so on, again, if you can get a term at least to match the capital allowances, which would be usually 7-8 years, that would be normally the minimum you would hope for, and if you can get it a little bit longer in terms of term. Most banks will have a term in mind depending on the type of investment. But if you go in with a term of your own in mind and do a bit of negotiation, sometimes there is a little bit of flexibility there. You want to make sure, I suppose, to try and match the term, and the banks will be obviously aware of this in terms of your repayment capacity. What I said earlier, if you have tried to pay back a very high cost or high value loan too quickly, that's putting, going to mean your repayments are going to be very high. You might end up paying a lot less in interest, but it's going to put you under pressure if you come to a year where cash flow maybe isn't so hot. So trying to get a term that gives you a bit of scope to manage it in good years and bad, and then if you do hit a good year, gives you the scope to throw in a bit of extra cash against it if you want to repay it that bit quicker, is the ideal scenario.
That's it for this week's episode of the Dairy Edge podcast. My thanks to Kevin Connolly for joining me on this week's show. Don't forget to rate, review and subscribe to the podcast. You can listen on Apple, Spotify or wherever you get your podcasts. And for more information, go to the Teagasc website at teagasc.ie. I'm James Dunne, and join us next time for your Dairy Edge.